market trend model, an 8-stage market lifecycle roadmap. First of all, what will you learn? The promise is, for the market trend model, I will show you how to decide when to go long or short using an 8-stage market lifecycle roadmap, so you can increase your win rate and avoid getting stopped out by being completely against the market while seeing big missed opportunities. So that's my promise for as the outcome of the webinar. Basically, I'm answering the question, why watch this? So the methodology I will be showing is, first of all, simple and systematic, which makes it easy to learn, works across all markets, across all time frames, and can be combined with existing methodology. So how will we be learning the market trend model? For each step of the roadmap, I have so the system within the system, if you will, the system not for trading but for training. I use a T.I.R.E system, the system within the system, basically learning how to learn. So it's a 4-step methodology. First, we look at the theoretical model, the theory behind what we are trying to learn today. Then I'll be constructing indicators, the I of the T.I.R.E acronym. Then I'll be drafting some rules, and then we'll go into the exercises. So let's begin with the risk warning. As we know, there's a high degree of risk involved in trading. Past results are not indicative of future results, and S.M.A.R.T systems and all individuals affiliated, that includes me, assume no responsibilities for your trading and investment results. I do not give any kind of guarantees in my presentations except one, that you will have losses in trading. Challenges, things we will actually, a lot of you are facing, and I have faced before. Challenges, things that are giving us a headache and that are troubling us in trading every day. I mean, without me serving as an exception, I've been through all of these challenges myself, and I'm sharing the scars. I'm showing you my scars so you don't have the same wounds. So these are things that I have faced myself. So first, frustration. Tell me if this looks familiar. So the market is having a bit of a correction. You see some kind of a support level. I don't know, now it's like fashionable to have ICT and all these sort of theories. So you've got a correction, and you say, okay, I'll place a buy order because I think the market is going to bounce from here. But the market doesn't bounce, continues falling, and you get stopped out. So you have another support level, demand level, however you want to call it, and you say, okay, now this time it's looks ripe for a very big rally, so I'll place a buy order, and then the market goes through the level, and then you get stopped out. So buying support, so-called support, and selling so-called resistance. Does this seem familiar? So that's the first challenge we will try to be solving. Again, this is the T.I.R.E system where we are. Frustration number 1, support resistance. So frustration number 2. Again, usual scenario, you've got the market having a trend, and then below is an oscillator. Pick your favorite. Now this is the one I have here is the RSI. So market is overbought, and you say, okay, the technical analysis book say the market should fall. So what I'll do is I'll place an order there to short, but the market hasn't read the technical analysis books. It starts rising, and then you get stopped out. So you have another overbought signal. Say, oh, definitely now the technical analysis books are going to be correct, and the oscillator is on the overbought zone. So what I'll do is I'll place another sell order there. And what happens? You get some chopping motion, and then the market starts going sideways, and then starts increasing, rising, and then you get stopped out. So you have another overbought condition. Definitely now we are. This is the opportunity for the market to turn. In continuous increasing, and rising, you get stopped out, and then you have a final, you have another opportunity to short it because you say the overbought indicator is there, plus I have a bit of a divergence, so I'll short, and then you get another losing trade. Does this look familiar? So that's the second frustration, buying oversold and selling overbought. So let's look at the third frustration. So again, usual market scenario, you stand off your charts, you look at the market, you're not 100% sure what to do, you check your favorite guru on Twitter, now X, and he says, oh, you should be buying, the market looks ripe to go up because XYZ. And then you check out the news, and then they tell you on the news that it doesn't look so good, and because XYZ reason, you should be shorting. So you don't know, should I be long, should I be short? You have no clue, no directional bias. Should I go long or should I go short? Completely confused. So this is the third frustration we'll be dealing with. So support resistance, overbought, so-called overbought, and no bias. So what are the consequences of all this stuff? Basically burning money. So consequences can be financial and emotional. Loads of losses, a very low win rate. Catching small moves, because sometimes you will be profitable, but you have a small average profit per trade. That will give you emotional burnout. And finally, you'll have doubts and indecision as to when to pull the trigger, because lots of losses, small winning trades. I mean, is it really worth it? So that will give you definitely doubts. So let's look at the problem, because what we saw today is so far was the symptoms. So again, before we look at the solution, we must find the problem. So these three situations I just show you, buying support resistance, buying oversold, selling overbought, and no directional bias, have one and the same root cause, and this is it. Standing in front of a freight train. This is the problem that you're having. Basically, you're standing in front of a freight train, meaning you're going against the trend. So that's the problem. So what is the solution? The solution is trend alignment. So what is trend alignment? First of all, a very quick definition of trend. Uptrend is making higher swing highs and higher swing lows. Downtrend making lower swing highs and lower swing lows. So if that's an uptrend, a downtrend, how do we, align ourselves with the trend? Let's try to understand the concept first of all of trend alignment through a driving analogy. So imagine you're driving a car, and you're on the road, and you can be going direction north, or you can be going south. Trend alignment is following the road, staying on the right lane, and following the direction of the road, the correct direction of the road. If it's going north, this is what we should be doing. Stay on the correct lane and follow the road. So if you're going south, this is exactly what you should be doing. So this is the way to align yourself with the trend. So think of it in that analogy. Just follow the correct direction and also stay in your lane. So if the market is going up, have a long bias. So if the market is falling, have a short bias. So what are the benefits of trend alignment? So let quickly show you some trend alignment. Here is a chart of FX, a euro, and I've got a swing chart. Some people call it zig-zag. Basically, it's one of these indicators you draw through hindsight, but it's useful for statistical analysis. So profit opportunities are much bigger if you follow the trend. For example, the first upswing was 7.6%, the second 7.72%, the third one was 7.25%. So if you add this together, it's roughly 23%, 22%. So that was your total profit potential. I'm not saying that you would have traded the whole of it, but this is how much was there for the taking. But if you wanted to go counter trend, you would have one downswing 2%, second downswing 4.5%, and the second one is 1.15, at least at the time of writing, because if the market shook up or shorted up, because that's one of the problems that we have with the one of these indicators that are based on hindsight. But the 1.15% was the total amount of the decline you had. So there was a lot more meat on the bone, if you will, on the upside rather than on the downside. So a lot of much bigger profit potential. So trend is your friend. Trend alignment, again, the same thing with downside. Much bigger downswings than upswings, because that's the definition of the trend. The high swing highs and the low swing lows. Then in a downtrend, the downswings are much bigger than the upswings. So again, if you should be shorting, aligning yourself with the trend, much more room for room to take advantage of. So another benefit of trend alignment is the uptrend is more forgiving to imperfect long entries. Now, what you're seeing is some mechanical signals I've got generated by the S.M.A.R.T signal system. It's a system I use with pattern recognition. It's part of the roadmap I showed you. It's the module 10, I think. And it automatically generates buy and sell signals. Now, of course, you've got the option to have just the buy signals or just the sell signals, because if you have a buy to be long, you don't want to be looking at the short signals. So, for example, since we're talking now on trend alignment, bullish trend alignment, and the uptrend is up, you want to be taking long signals. So, just take a closer look. The trend here, the uptrend, is the signals were a bit imperfect. So for example, this was a bit early and that was a bit late. So the uptrend is more forgiving to imperfect long entries. Similarly, the downtrend is more forgiving to imperfect short entries. What happens if you have misalignment? Again, more losing trades, losing trade, losing trade, losing trade, and smaller average profit per trade, assuming that you got some piece of the action there. All of these were very small moves. I doubt it if someone could be that nimble, but even if you did, you have smaller average profit per trade, and of course less margin for error with your entries. Let's do another test to see the benefits of trend alignment. SPY ETF, account size 100,000. Set up the signal is the RSI 4 crosses the 20 level, basic run-of-the-mill use of the RSI indicator. And you get stopped out when the RSI 4 crosses over 80. So what I'll do is I'll do two back tests, one with a bullish trend filter and one with a bearish trend filter. So basically I'll be taking long signals in a bullish environment and taking long signals in a bearish environment. So here are the results. The numbers that nothing really matter. You can just focus on the equity curve, because the point I'm driving here is because that system, of course, is very simple. Is that one is a losing system, the one is a profitable system, trading the exact same entries, exact same position sizing, exact same exit, entry, exit, and position sizing. The only thing we change is the setup. So in the 4S framework of system, setup, signal, stop, and size, the setup is the one that makes the difference in this particular example. So buying technical signals on the bullish market is much more profitable. So we go from loads of loss to a low win rate to having higher win rate, catching larger moves, better entries, and more confidence to pull the trigger. So I think it's definitely worth keeping ourselves aligned with the trend. Again, back to the T.I.R.E system. So the sixth part of the presentation is trend alignment. So let's build the theoretical model. Now it's time to build the actual model. A blueprint, if you will, of trend alignment, and it has to be rules based. So first of all, I'll do the theory, and then I'll flesh it out with indicators. So the question is, what is the trend, so we can align ourselves with it? To me, asking what the trend is like asking what is the time. So for example, you've got hours, minutes, and seconds. Similarly, you've got long-term, medium-term, short-term trend. So if you want to be align yourself with the trend, you've got three trends to consider. So this is the market cycle model by Ian Notley. It's a very nice visual, theoretical framework, if you will, showing how markets move, you know, the interplay between the three trends. I'm talking about trends, not time frames. And I've always found it very fascinating and useful, but it was a bit too, you know, how can I put this, academic. I needed to do something systematic, so I can, you know, flesh this out and actually use this, because I'm not an analyst, I'm a trader. So the question is, how can we use this, you know, template, if you will, systematically? So this is what I did. First of all, I did was to make it, in order to have it, make it rules based, I wanted to quantify bull versus bear markets. Secondly, I wanted to quantify the various bull and bear market stages that market goes through a complete cycle. And third, I wanted to reshape this sine wave so I can have more clearly visible both the bull and bear, and also the rotation between these two. So this is my framework, my model, the market trend model. So first thing is have a clear distinction between bull and bear markets. And bull and bear markets, but when you're in a bull market, you have two types of action. So you have bull and bear. So within a bull market, you have two types of action. First of all, you've got the what, you know, Elliott wave people might call the impulse move, which is, you know, rising in a bull market, and then you have the corrective part in a bull market. And similarly, you've got the impulse wave of the trending move of the bear market, basically falling in a bear market, and then you have the reaction, the counter trend part of the bear market. So we've got these basic four situations, but I think it can be subdivided, because each rising part of the bull market is comprised of two parts. First of all is what I call bull market resumption. So imagine having gone through a correction, and the market is like kind of like basing or rebounding. That's basically the bottom half of a rally, and it's different than the second part. So you're kind of like basing or rebounding. This is stage one, bull market resumption. The second part is the bull market rally. This is when the market starts accelerating. It's the top half of the rally. And also here the market is not more basing, it's making new highs. So both of these, stage one and stage two, are bullish within a bull market, but there is a distinction between them. Similarly, on the counter trend part of a bull market, you've got a retracement, basically a pullback, just your run-of-the-mill normal correction, a small size. And then you've got a bull market correction, which is like a deep dive, a larger one. So both are counter trend moves, a retracement and a correction. The difference is the size. And sometimes the retracement doesn't have to be in size, can be in time, but we'll get to it a bit later. Similarly, you have a bear market resumption, which is the equivalent of the bull market resumption. So you basically had a counter trend rally, and then the market resumes the downside. It's a bear market rally failure. It's the top half of the fall. Again, you have acceleration. That's the bottom half of the fall, making new lows. It's a bear market round down. So the round down, stage 6, is the equivalent of the bull market rally. So then you have the pullback. Again, normal correction, which is the a bear market bounce, the equivalent of the bull market retracement. And finally, you have a bear market rally. Once the bounce has gone significantly higher than the bounce, the trend has not changed. So it's the equivalent of a stage 4 bull market correction. So the market can be in any of these 8 conditions. So this is a market trend model. This is what we will be using to define market action in a very systematic and rules-based way. So this is the framework, 7th step in the theoretical model part of the presentation, market trend model. So let's look at the indicators. How we'll be fleshing it out. So how will we go from theory to practice? So what tools will we go to define the trend? Now there are various types. Let me digress here a bit, a bit more to help you out, put things in context. There are many ways to define the trend. Each one has its pros and cons, but in general, let me group this for you. First of all, you go filters like swing lines. Sometimes people call them zigzags and this sort of stuff. So this is, a typical example, but these have problems. The problems these have are repainting. I mean, if you check out the top part here of the last part of the chart, when the last up leg, if market price starts going down, what you see as an upswing, it will stop qualifying as an upswing, and the market start actually the market goes down, the upswing will disappear, repaint itself as a downswing. So there is a lot of issues with that. That's a lot of hindsight. So this is part I'm talking about. This is the part I'm talking about. It will start repainting. In general, these are not, suitable for real-time use hindsight trading. You can have a lot of optimization. For example, these swings are only known with hindsight. And also you have calculation issues where you use percentages, ticks, or even if you use other measures, you have a lot of subjective parts to it. So I try to avoid filters. I'm good for statistical analysis, but not for real-time trading. So I don't want to be avoiding filters. Second thing, the second way to define the trend is with smoothings, for example, like moving averages. This is an example of a market with a moving average on it, and the simple stuff is, if it's above, it's bullish. If it's below, it's bearish. But the thing is, you get a lot of these areas when you have whipsaws, as it's called. Markets bullish and then suddenly bearish, and then it's bullish, and then 3 bars later it's bearish, and then it's bullish, and then again it's bearish. So there are a lot of ways to get whipshot, and not very, very effective. I mean, it's not the best tool. It's not the best tool. This is where I was worried. I didn't want to use moving average for trend definition. So whipsaws you love, plus it's very binary, so it's bullish or bearish. That's it. So the third way one can use is indicators, and I'll show you some tricks now. Perhaps you didn't know this. Alright, so top part again, Euro FX, the bottom is the RSI, and you've got a moving average plot on the on Euro. And I'll show you a little formula, which I know. There is a mathematical formula that you can use indicators as trend proxies that help you relate the RSI indicator to a moving average. And this is the formula. The RSI X, where X stands for the look back period you're using, standard being 14, but you can use to 10, 50, whatever. When the RSI X, let's say 50, does a zero line crossover, it is exactly and mathematically the same as in the close doing a crossover of an EMA of half the look back period of the RSI. So basically, if you're using an RSI X, X being 50, and it crosses the zero line of the RSI, then it's equivalent to the exponential moving average 25, the price, the close doing a crossover of the moving average. So it's a moving average crossover proxy basically, and this is how it looks like. So basically, next time you're using an RSI, you can know that it has a zero line crossover. You know that the price is above or below the X divided by 2 moving average. So it's a moving average crossover system proxy basically. So likewise, I can have with the MACD, the indicator, or the MACD if you will. It's roughly, not as accurate, but roughly the classic MACD or MACD with a 12 and 26 setting. When it crosses the zero line, it's almost equivalent to a 50 bar exponential or simple moving average. It's not as accurate as the RSI, but roughly it's the same. It's roughly the same. So again, these are useful tricks for trend definition, but it leaves us with the same problem, that these are moving average crossovers, and again, these are lagging with a lot of whipsaws. So I don't want to be using this type of like swing filters, zigzags, and smoothings, moving average, or indicators. And because of these problems, I saw these problems and I decided to create my own solutions, sort of like I did with the MACD. When the MACD had a lot of with the MACD had a lot of issues, and I decided to address these, if you will, so and created the MACD. So again, there are other miscellaneous ways. So the market trend model basically is created using in order to approve all of these shortcomings and define the 8 stages. I created a proprietary trend definition algorithm. It has a lot of moving components to it, so this is a closed code indicator, but this is how it looks like basically. Color coded the stages, which I'll see in action in a few seconds, and basically the stages can be displayed as color coded bars or as a bottom chart heat map, or both. You can have either or both. So we've got these 3 options. So let's see the stages in action. First of all, stage number 1. Now you can see in the inserted graphic there where it is in the market trend model. It's the bull market resumption. Basically, you had a decline, and the market is on the impulsive or the trend following part of the bull market, and it's just bottoming out, and it's the bottom half of the rally. So then the market continues rallying. So you have bull market stage 2. A bull market rally, and it's an acceleration. It's the top half of the rally. You're making new highs. You don't get many pullbacks. I mean, they're very shallow, so you have to be adjusting your entries and exits, something we will see later at the rules part of the presentation. For now, I'm here to present you how it looks like and go from a theoretical model to the indicator. Then you have the bull market retracement. Again, your normal pullback correction, and then you have a bull market correction, which is a deep dive, a larger correction, if you will, than a simple pullback. That's stage 4. And then we move into the stage 5, which is bear market resumption, the equivalent of the bull market resumption. So basically, it's the failure of a bear market rally. Then you go to a proper full house bear market resumption. A bear market rundown. So this is the rundown range. Basically, it's the equivalent of the bull market rally. So bear market rundown, making new lows. So the second part of the decline. And then you have a small bear market bounce, stage 7, which is the equivalent of a retracement. And then it might go on to something more significant, like a bear market rally. Obviously, if it fails, it goes back to stage 5. So this is the 8 stages of the market trend model, systematic, rules-based. Market trend model. So let's go into rules. What are the rules? Because everything I do has to be rules-based, because we have to follow the rules, or else follow the fools. Okay, so the rules here is I'll show you how to grade your trades, what I call TradeGrade, or sometimes I call it a setup score, if you want to be a bit more mathematical about it. So the TradeGrade, what is TradeGrade basically? We all know the adage, follow the trend. Trend is your friend. But are all trends of equal risk? Because in the market trend model, we see 8 stages within this life cycle roadmap, and there are uptrends, both within a bull market and uptrends within a bear market. Then you've got corrections, and so these 8 stages, how can we classify them, grade them, so when someone wants to be taking a trade, they know exactly how to grade it, both real time and also a bit later for their journaling, because it's extremely important to keep a journal and start studying when most of your losing trades come from. So in order to do attribution analysis and know that, okay, most of my losing trades come in these conditions, you have to grade them. So Are all trends of equal risk? Clearly not. That's why I created this, the TradeGrade concept or setup score, so people understand and that not all trends are the same, and also we can identify and classify that risk. So let's try to see this. So for long position, I'll do this for long and short. An A type grade from a setup point of view are stage 1 and stage 2. So when you take long positions in stage 1 or 2, we give ourselves an A grade. And I think when people start to begin to trade, they should be taking only A grade trades. This is very, very important. So this is how it looks like, the market trend model, stages 1 and 2, and this is the environment I want you to be only taking long trades when you begin. So if, as I mentioned, the 4S framework for creating strategy, if you remember in the roadmap to rules-based trading, was the 4S framework: setup, signal, stop, and size. So assuming the setup here, I will exclude macro. Purely technical, if the setup is stage 1 and stage 2, the signal is to be taking breakouts and very shallow pullbacks. Again, I use a mechanical way to define these, but basically breakouts and shallow pullbacks. The stop is let winners run. Your strategy here is to try to gain as much as you can from the prevailing trend. So use the smart trailing stops and targets, smart stops, trailing and targets, because there are different methodologies for stops. You can be trailing them, have targets, very short-term exits, which are adjusted basically on the type of trade you want to be taking. And when we're in stage 1 and 2, because we have the positive backwind, we're going to be trying to let the winners run. Then we're going to be the size, we're taking full size, 2% of our portfolio. We want to be pushing it a bit. And stage-specific factor behavior. Now, because as we mentioned, the trading I do is multiple factor, multiple time frames, multiple factor. I combine technicals and macro. So these are the stage-specific factor behavior I look at. I look for the MACD to making new momentum highs, and I avoid shorting so-called overbought, especially if it's the first. The first overbought sign, and I'll be telling you about this more at the MACD module. The volatility valuation index should be decreasing for equities. For rallies, usually volatility decreases for equities. It's the opposite for commodities. The smart sentiment composite should be also improving. If there are any negative news out there, just ignore it. There's a negative news bias, especially for media. And the commitment of trader report system should be showing commercial selling minor, a sell signal. These only signals small pauses to the big trend in the weekly chart. So these are what you usually get from the macro and the other technical factors. So by and large, breakouts and shallow pullbacks. So this is how that looks like for the smart signals. Again, this is module 10. The signals based on pattern recognition. As you can see, that some entries were very good, some were very close, but in all cases they were very forgiving. Again, this is an ideal type of trend. So as you can see, long position getting really very we're aligning ourselves with the trend. So let's take a look at short signals. Again, this comes from the mechanical signal system. As you can see, most of them are losing trades because we haven't aligned ourselves with the trend. So this is B trade are stages 3 and 4. Basically, we're still with the trend, but we are trading pullbacks. We're waiting for the trend to realign because we're betting that the market will, in the big picture, will keep its long-term trend, and this is just a temporary pause, either brief as a retracement or a bit longer as a correction. So these are your big grade trades. Again, these are pullbacks and corrections. Wait for trend realignment, wider stops and quicker exits. Again, this is all covered in the smart stops module. Here we go to normal size, 1% of risk. And stage-specific factor behavior, look for the MACD to have extremes, stage-specific, so you can start pinpointing the potential bottom. The volatility valuation, again for extremes, these are extremely useful tools for letting me know when the market is near the bottom, exhausting itself. The S.M.A.R.T sentiment composite is negative, again looking for a reversal. And the commitment of trades report system on the weekly chart will be giving commercial buy, major buy signals. Again, this is what I look at during these stages to help me define, the end of the correction. Here's an example. Again, the volatility valuation index became in very high levels near the bottom, and when the S.M.A.R.T signal system came on, we had already some kind of an exhaustion alert from the volatility valuation index. So what are the C grade trades, stage 7 and 8? In theory, we could be taking some short-term trades here because the trends are kind of bullish, basically, even within the context of a bear market, and I will leave this as a potential trade, because there are factors that may allow us to take an exception. Strictly speaking, we should be taking A and B grade trades only. But for people in my community, they may see examples of me taking C trades, and the reason is the following. These are counter trend trades, no doubt about it, and you need a lot of macro factors to support it, but eventually sometimes you do get that. So stage 7, which is the bear market bounce, like the equivalent of a retracement, more often tends into stage 6, i.e. a resumption of a downtrend, a bear market round down, rather than stage 8, which is the bear market bounce. So most of these bounces don't turn into a rally, bear market rally, they turn into a round down, a resumption of the previous bear market. Similarly, a stage 8, most of the time it turns to stage 5, i.e. recycles within these stages from a bear market rally to a bear market resumption, which turns again into a bear market rundown. But occasionally, sometimes it goes into a stage 2, which is basically a change of trend for bear market to bull market. So if we think we are in such a condition, and we need a lot of support from all the macro we're looking at, because macros move markets, not charts. So the signal is, again, very shallow pullbacks, very wide stops, again, refer to the S.M.A.R.T stops module. Now we'll be trading half the size. So 2% it goes for stage 1 and 2, the upswings in the bull market, but for upswings in the bear market, we'll be taking half the size, or actually quarter, 0.5%. So stage-specific market behavior, looking the MACD to be making new momentum highs, volatility, the VVI to decreasing, S.M.A.R.T sentiment composite was very negative but improving, and we see a lot of coming off of commercial sentiment, coming off of a minor buy signal. And last but not least, we have D grade trades, which is stage 5 and stage 6, basically bear market resumption and bear market rundown. So what are the strategies for these? This is stage 5 and stage 6. Signal no long positions. So what is the stop? No long positions. Size, no long positions. Do not, repeat, do not at any circumstances, even if you hear the Warren Buffett or any kind of your favorite guru is buying, do not take long positions in stage 5 or 6. This is what we usually get. The MACD is making extremes, new momentum lows, volatility valuation index increasing at an extreme, signaling trend exhaustion. But I'm not willing to bet my money on it. I will be waiting for trendy realignment. S.M.A.R.T sentiment composite, very negative, could be at an extreme, as again we'll be seeing the S.M.A.R.T sentiment composite in module 3, and the commitment of trade report system, that's module 2, for commercial buying, again looking for minor buy signals. So this is the background from a macro point of view, a technical point of view, but strictly from a trend point of view, do not take any positions. These are your D grade trades, and I'm willing to bet that if you look more closely into your P&L, a lot of these trades come from losing trades comes in stage 5 or 6, your long positions. Now, of course, we got the equivalent for short positions. A grades are stage 5 and 6. B grade trades are 7 and 8. C grade trades are stages 3 and 4. And D grades are stages 1 and 2. Basically trying to short bull market resumption or bull market rallies because you got overbought and so on and so forth. Again, I'm willing to bet that a lot of your losing trades are D grade trades, either through long or short positions. So now that we've done the rules-based, the rules in the T.I.R.E system, did I keep my promise? Because I mentioned if I keep my promise, I might have the opportunity, might give me an opportunity to do a small pitch of what I do. So where was the promise? Again, a small reminder. I would show you how to decide when to go long or short using an 8-stage market lifecycle roadmap, so you can increase your win rate, avoid getting stopped out by being completely against the market while seeing big missed opportunities. Again, the promise was that the methodology will be simple and systematic, easy to learn, work across all markets, across all time frames, and would be combined with existing methodologies. Did I keep my promise? So where to from here, those that are interested? The first bonus, you can get the course for free, the whole training program for free. You can get the Market Review open code for free. Yeah, it's available in TradingView, Stock Charts, Metastock, MT4, and I'll be uploading it to other various platforms as well. And you can also get the awarded paper. And since you managed to stay awake during the presentation, all you have to do is basically email me at alex@alexspiroglou.com. So, thank you for your attention. I hope I managed to keep you awake during the presentation. Feel free to email me for the bonuses, and also if you are interested in joining the community.